Hey everyone, you're watching my daily trade log. I document one of my option trades for your benefit so you can learn from it and you can learn from my mistakes as well as my wins, and hopefully you'll be able to start making money trading options if you're not trading just yet. So today is my trade number 228, and it was actually quite an interesting trade. I traded Nike and I purchased a double calendar. So for those of you who are new to options trading, you would be wondering, what is a double calendar? A double calendar is when I sell a strangle. A strangle is when you sell a put option and a call option at the same time, expiring at the same time. And what makes it a double calendar is that you also purchase a strangle with the same strikes but further out in time. So what I did is I sold the February 115 put option and the 140 call option, and I collected about 78 cents credit. And at the same time, I purchased the April same strike, so the 115 and the 140. So the total cost of this trade was $5.49. And that's because options further away in time, they are always more expensive. But why did I do that? Why did I purchase options when I normally sell options and that's how I make money? Well, that's because I'm trying to take advantage of the low volatility. The volatility is very, very low at the moment. So if we jump over to the daily chart, we can see that this is the volatility over here. And it's currently sitting at 0.9 up here. We can see the IV rank is 0.9. The volatility is super low. And we can see a nice cyclical movement of the volatility. And that obviously aligns with the earnings over here. I indicated it with a line, so it's like a nice waveform. So we can expect the volatility to go up. The next earnings is at the end of March, 20th of March, and the volatility must go up because of the uncertainty around the earnings. So currently the April volatility is 33.2%. while the February is 28, so there's barely any difference. So my intention is that hopefully my February strangle, the one that I sold, will expire worthless because it's quite far from the current price. It's only sitting at 0.9 delta. So I have a probability of 85%, which is very high. And if this expires worthless, then all I gotta do is I can either go onto the next weekly and sell the same strikes again, or I can go to March and do the same thing, sell the same strikes. And that will lower my debit that I had to spend on this particular trade from 549. If I can bring it down, that would be good. Now, the other important factor to keep in mind is that because the volatility is expected to go up as we approach the earnings, the April expiration, which is after the earnings, that's the first monthly expiration after the earnings, those option prices are expected to keep their value fairly well because the volatility will push the prices up. But we also have to factor in the time decay. So we have these two forces fighting against each other. So the volatility will push the option values up, and the time decay will push the values down, but the volatility normally has a stronger impact. However, the April expiration is still 87 days away, so that's quite far from now. But I am still optimistic that those options will keep their values and I'll be able to lower my cost basis because my short strangles, so the ones that I sold, will lose their value. So that's the trade that I put in. That was my trade number 228. I hope you find it useful. I know it's a little bit complex. I tried to put together a diagram which may help to understand how it works. So that's basically the strangle that I sold. I collected some credits. Ignore the numbers because I put this together for another trade, I believe last week or the week before. But the theory is pretty much the same. The shorter expiration is going to expire before the earnings. This is the line that shows the earnings, and the April one will expire after the earnings. So as you can see that the sloping of the red line is less than the sloping of the green line. So that's how I'm hoping to profit from this trade. It's a very low risk strategy. My maximum loss is limited to the amount of money I spent on it, which was $549. When we're talking about options, then you have to multiply the figure by 100 because each option covers 100 stocks. So that's how you get to the 549. So I hope it makes sense. Well, that wraps up my trade number 228. I do have another interesting fact to share with you. Yesterday, or last trading day, which was last Friday, I traded Wayfair and it is burning me big time at the moment. As you can see, we experienced a massive 20% increase on Friday, and one of the things that I like to do is when I see a big jump, then I like to sell a call option. If I see a big drop, then I like to sell a put option. And I did actually profit from this trade. When I saw that it dropped, then I sold a put option and I benefited from it. But now, after seeing the Friday jump, I did sell the $60 call option, not thinking that today we're gonna see a huge jump, and that is really testing my position. But this is where trading psychology comes in. You must stay level-headed all the time. You have to make rational decisions. It's not worth panicking. And what I'm hoping is that the price is going to come back down. I mean, we do have a massive gap in here, and normally gap needs to be filled. That's just how it is. So this trade is testing me, and I wanted to show you this, that, you know, trading is real. You can lose money, you can win money. The most important thing is that you win more than what you lose. So losing is part of trading, and you just have to get used to it if this is something that you want to do. So I hope you find this useful. I hope you enjoyed this video. Please hit the like button, subscribe to my channel if you haven't done so, and spread the word and start making money trading options. Thank you for watching.